Good afternoon, everybody. I'm Rob Murphy, Head of Investment Companies at Edison Group. And today we have the fourth and final installment of our series on real assets in an uncertain world. So as we've summarized before, we're in a period of increasing geopolitical instability, rising inflation, and tightening monetary policy. And we're talking to a number of companies in the sector about how their funds might offer, interesting investments for investors during this period. So I'm delighted to have three excellent funds today, and we're going digital today. So we've got media and technology companies. So first of all, I'll just introduce the panelists. We have James Bruegger, who is CIO of Seraphim Space, which is the manager of Seraphim Space Investment Trust. Welcome, James. Next up, we'll go to Stephen Marshall, Chairman of Cordiant Digital Infrastructure Fund. Welcome, Stephen. And finally, Josh Gruss, who is founder and CEO of Roundhill Music, which is the manager of Roundhill Music Royalty Fund. All three funds listed on the London Stock Exchange and all actually IPO'd relatively recently. So it's great to have everyone here. Welcome.
Thank you.
So let's kick off then with the kind of core drivers. We've got volatile times, but ultimately I think investors are looking for, what is the long-term driver of my investment. So we'll start with that question, and we'll go to James first. Maybe you can talk a little bit about some of the assets classes you're investing in and what the drivers of those are.
Sure, happy to. So the fundamental drivers behind the revolution that's happening in space that led to Seraphim Space Investment Trust IPOing last year are that you're seeing a complete paradigm shift in the economics of putting things into space. So I'm talking between already a 10 and 100-fold decrease in the cost of putting things into orbit. What are the drivers behind that? There are two primary drivers. The first one is the advent of reusable rockets and falling launch costs. If you think about Elon Musk and SpaceX, that's having a massive impact on reducing the cost per kilo of putting things into orbit. And on the other hand, the second key driver is now being able to make satellites out of the same componentry that goes into your smartphone. So satellites that we're typically backing are the size of a shoebox. They might cost less than $100,000 to produce. You contrast that with the traditional space market, where satellites historically would have been the size of an SUV, weighed several tons and cost hundreds of millions, if not billions of dollars. So you're seeing a dramatic change in the cost of putting things to orbit. So what does that translate to in terms of the opportunities that Seraphim is focused on? Well, put simply, for the first time, it's now possible to launch constellations of hundreds and even thousands of satellites for a commensurate cost of only putting up 2 or 3 of the older, larger, more expensive satellites. So we like to think of this as being analogous to a new digital infrastructure in the sky that is enabling just a huge amount of connectivity. So if you think about, again, the likes of SpaceX with their Starlink project, OneWeb here in the UK, and indeed Amazon, all planning these huge constellations of thousands of satellites to blanket the world in high-speed internet connectivity. So being able to connect the billions of people who still don't able to get online reliably. Likewise, being able to capture image in incredible fidelity, every square meter of the Earth, every few hours at global scale. Massive applications and everything from helping to combat climate change, or indeed, as I'm sure we'll come on to talk about,
Yeah, thanks, James. We can come on to that. And maybe just to add on, how do you think the demand and the drivers will be affected by economic cycles in these kind of companies that you're running?
Yeah, it's certainly a question that's taxing us a lot at this point in the economic cycle. Look, I think the fundamentals, the opportunities that we're going after are undiminished. These are multi-decade long opportunities that we're going to see a ripple effect as a consequence of those changes that I've talked about, that we think is going to disrupt every sector terrestrially. And of course, traditionally, governments themselves have been very large consumers of space data and connectivity. So certainly in a downturn, access to capital, the cost of running businesses, supply chains are things which we certainly think about. But in terms of the fundamental demand for the kind of services and products and technologies that our businesses are backing, if anything, what we're seeing is an increase in demand for those solutions as a consequence of where we are in the economic cycle.
Great, thanks, James. So yeah, maybe moving more terrestrially. Stephen, so Cordiant is investing in core infrastructure of the digital economy. So what's driving those markets? And again, how do you see that being impacted by economic cycles or financial markets?
Thanks, Rob, and we are really more grounded than James. We have real assets on the ground. We invest. Cordiant Digital Infrastructure invests in the plumbing of the internet, if you will. So the actual physical towers where the mobile operators install their antennas, the fiber optic networks that connect to those towers, connect to customer premises, connect to data centers, etc., and also data centers themselves. And it is really the real assets in each of those instances rather than the technology in which we invest. And we listed Cordiant Digital Infrastructure on the London stock market last February 2021, so just over sort of 15 months, with a mandate to invest in those assets in both UK, Europe, and the US. And the sector is sort of widely coveted by investors for some very, I guess, obvious reasons. The demand across the internet continues to grow at 30 or 40% a year, has done for a number of years, and most forecasters are expecting that to continue. And it's somewhat intuitive. You know, we all utilize the internet, we're all streaming, children are uploading content. Even this panel today is taking up enormous bandwidth right across the network and with server capacity in the data center. So there is an underlying obvious and fairly substantial growth in the demand for capacity in which we're investing. The second point is when we invest in these assets, whether it be physical mobile towers or the fiber or the data centers, you're usually signing up with blue chip customers or government entities, and you're usually signing up for under long-term agreements. You know, if a mobile operator puts an antenna on a tower, they want to have certainty that they can retain that position for many years to come, because the cost of decommissioning and reinstalling or finding an alternative position is extremely expensive and disruptive to their RF network. So usually you sign up long-term contracts, and because you're signing up long-term contracts, you embed in each of those contracts an escalation clause to protect, you know, the supplier, you know, for any inflationary impacts. So what these characteristics drive, in effect, the underlying growth in the marketplace, the demand for more capacity, blue chip customers, long-term contracts with inflation protection, it drives some very consistent growing cash flow streams, which make these products very, very interesting prospect for an investment, from an investment perspective.
Thanks, Stephen. Yeah, we'll come on to the sort of future demand, because that's also been quite clear as well. Yeah, over to Josh. The reason I included or invited you guys to join this one is, although I guess, you know, you're looking at streaming, you know, royalties, and it's driven by, you know, a number of factors which you'll go on to, but it has many of the characteristics a real asset. It's almost like a virtual real asset, if that makes sense, because you've got effectively sort of very long duration, long surviving, predictable, dependable cash flows. So I thought that's, and actually, obviously, a lot of the growth in your business is actually on the back of what Steve and probably James is doing as well. So I think it fits in really well. So maybe you could talk about what's driving the music royalty space in terms of the incentives to sell, to buy, the shift in the market in terms of how people are consuming music.
Streaming has really been the story for the growth in music of the last 7 years or so. So, streaming growth continues to climb at maybe 20% growth per year. But there's other types of consumption as well. People are going to concerts, they're listening to music in more traditional areas of bars and restaurants and clubs and broadcasts of television. There's music, there's broadcasts of music on radio, on satellite radio. And so all these different income streams have different drivers behind them. They're all quite resilient and sort of defensive in terms of a recession. People are listening to music in good times and bad times. People are probably not going to let go of their favorite streaming service. Is a pretty inelastic product. So, so those are some of the ways in which music royalties end up being quite durable. And in terms of the marketplace, there's a lot of demand for these assets now. When Roundhill first started, the music industry was in a much more uncertain environment, and things have definitely brightened, and therefore there's a lot more interest in the space. But we've had quite a good head start, and so relationships with artists, relationships with songwriters and the estates of deceased songwriters, that's the bread and butter that we live in terms of deal flow. So there's always plenty to do out there.
Yeah, and I think your point on economic cycles is interesting, because obviously everyone saw Netflix, and they seem to have been impacted much more by maybe the squeeze on consumers, and because you compare that with the Spotify numbers, it didn't seem like there was any impact of the sort of economic situation at all there. So you're just on mute there, Josh.
Yeah, that's correct. Subscriber growth for Spotify, continues. I think people want to have that one service that gives them the entire world's repertoire. That's a nice thing to have. Whereas Netflix and Disney Plus and all these different streaming services, offer a selection of shows, and so it's easy to sort of go with one or the other, or not have them all. But a Spotify subscription or Apple subscription is going to give you access to everything, and that's I think that having access to everything is something that people will continue to want in almost any environment. Yeah,
that's a good point. And so maybe we'll move a little bit onto the pipeline. So, I mean, Josh, you recently, this year done a couple of deals. We had David Coverdale and so some quite big names. I mean, how big is the potential still? Because I mean, I guess some people might say, oh, they've probably already bought the best assets. I mean, what's out there that you guys can still get involved in?
I mean, there's so much. I mean, it's almost endless if you think about it. Because every hit song of the past, if you think of that as an annuity stream, and you break that down to the fact that maybe that annuity stream was created by 3 or 4 different songwriters, So those are all separate pieces that can be sought after. There's the publishing, there's the recorded piece, there's the neighboring rights piece. There's all these different pieces of the copyright that can be acquired. So if you put it all together, there's a pretty healthy amount to do.
Great, thanks. I mean, maybe on to James then. I mean, you talked about where are we in this sort of stage of sort of infrastructure in space? So, you've talked about a couple of these, satellite constellations that have been going up. How much potentially could we see up there? I mean, how much capacity is there for infrastructure in space?
Well, without being cliched, space is obviously infinite, so there's plenty of space in which to in which to work. So where are we in sort of the trajectory of things? Well, I think a good reference point for that is in the entire history of the space age since Sputnik first went into orbit in 1957. It's been less than 15,000 satellites that have ever been launched, and more than a quarter of those have been launched by just 4 companies in less than the last 5 years. And those 4 companies alone are going to put up at least another 10,000 satellites and have aspirations for doing nearer 100,000 satellites over the course of the rest of the decade. And beyond them, there's more than 200 other companies that also have announced plans to deploy their own constellations, with another 100,000 satellites collectively that they're planning to put up. And many of those companies have already received private financing and have already started to deploy their constellations. So this trend is real, it's happening, and our view is that we're at a critical inflection point now in the potential of these really small low-cost satellites has very much being now proven. They're generating significant amounts of revenue, and we therefore expect this infrastructure to really accelerate over the course of the next 5 years. And it's the opportunities that come out of that the trust is focused on investing in.
Great, thanks, James. And Stephen, so I was looking at your last results release, and I think you said you had a 3 billion pipeline, and I think the previous published results, so you had a 2 billion. So there certainly seems to be quite a lot of investment opportunity there. I mean, what areas? Is it across the board, or are there particular areas where you see much more demand than others?
I mean, this is the 3rd largest infrastructure sector in the world, with estimates of annual capital expenditures of 600 billion a year on a global basis. So it's absolutely colossal on a global scale. We focus on UK, Europe, and North America. We focus very much on the physical infrastructure rather than any of the technology. And in the last 15 months, we've made 3 great acquisitions. We bought the national champion in the Czech Republic, which has got terrestrial coverage for across the whole of the Czech Republic. We are about to close and get government approval on the same asset in Poland, with full terrestrial coverage across there, and we own the most interconnected data center in New York, which we acquired in February. And our pipeline of opportunities really does fall across both those 2 sectors: the multi-asset platforms that we see in Europe and the data center platform in New York, but also fiber connectivity as well. So 3 billion is very much a sort of scrubbed pipeline of opportunities across those geographies. The pipeline is dynamic. Things come to marketplace. We decide to pursue them. We bid for them. We end up in bilateral negotiations in some instances, and these assets transact in the hundreds, if not billions, of euros and dollars size categories. So it's very much a dynamic pipeline. We're looking at assets at the moment in Western Europe, in North America, across data centers, across towers and fiber. You know, I see no you know, fall off in that demand. I mean, there are other challenges, of course, in terms of you know, rising inflation rates and interest rate environment. You know, I think one would inevitably expect to see the price of some of these assets come down. That has not happened yet. Still see people bidding, you know, pretty racy prices for these assets, and not really taking into account, you know, the increased interest rate environment. But I think that will happen in due course, and we'll probably actually see some distressed assets actually for people that have overpaid and overgeared some of these assets historically over the last couple of years. I think we'll probably see some distressed situations over the next couple of years.
Yeah, we'll come on to that a bit actually. I suppose the obvious one as well for you is the 5G. I mean, the big telcos seem to have been putting huge capex amounts out, not just to acquire licenses, but also to actually build out that infrastructure.
Yeah,
great.
Absolutely. So our tower infrastructure across the Czech Republic and Poland houses 2G, 3G, 4G, and increasingly now, you know, the mobile operators are looking to deploy 5G antennas. In some instances, they are decommissioning 3G antennas, but they've still actually got 2G out there because there's a large ecosystem that still relies on the 2G network. And any G, you know, when you look at it historically, any G normally takes the carriers anywhere between 5 and 7 years to fully deploy it across a national geography. So this is not a short-term lease-up proposition for us. This is a 5 to 7 year, you know, growing revenue stream that you know, as the carriers deploy antennas, base stations, you know, fiber optic, hybrid cable connectivity, etc., onto our telecommunication tower assets.
Right, that's quite clear what's happening there. And I thought we've discussed policy on some of the other meetings and regulatory drivers, and that's sort of quite clear for renewables and so forth. But I guess maybe moving on to Josh. In terms of the music industry, there's been a lot of headlines about artists not getting paid enough, and I mean, what's your view on the possible upside if the artists and the owners of the rights get actually a much bigger slice of the revenues, streaming revenues in particular?
Yeah, I think there's a lot of public misconception out there, because there's when you talk about the artists, you really have to talk about there's really two sides to the coin. There's the songwriter who writes the music and the artist who records that music on the record. Those are handled completely differently in terms of the copyright law and copyright world. So really what an artist gets paid a lot of the times has to do with the contract they strike with a record label, and that is really what will determine what an artist gets paid in that situation, from the likes of Spotify, etc. Spotify pays a very healthy amount to the record side. If you look at Spotify's margins, they're very narrow, and that's because the record side of the equation eats up a lot of pennies from every dollar that they generate. It's more on the songwriter side where there's an inequality, and I think that that has gotten a lot of attention, and the songwriters get paid around a quarter to a third of what the artist side gets paid. So there's an inequality there that really has to. The reason for that is that those rates, as opposed to Spotify and the record labels, they get to negotiate and figure out what the rate is going to be. On the songwriter side, those rates are determined, at least in the US, by the government. So a regulatory body called the Copyright Royalty Board. So it's a little complicated, but for those sort of the songwriter is heavily burdened by regulation, and that sort of bears down on sometimes some low payments. And the good news is that the CRB raised rates for songwriters from streaming royalties by 44% a few years ago, but that got appealed by Spotify and Amazon. And so our industry is kind of waiting with bated breath. Any day now, we'll find out whether the CRB is going to uphold that large increase or change it somehow. And we've been waiting for that decision for quite some time. So that's a big event-driven piece of news flow that we're waiting for in our industry.
Yeah, so fingers crossed. And James, I suppose you kind of touched on the fact that, you know, governments are working more with the private sector now. I guess the huge costs. I mean, all governments are pretty, certainly in developed markets, are pretty short of cash. And it looks like the private sector is able to do things a lot more efficiently. So, I mean, I guess would it be fair to say that's going to be a pretty strong support for what you guys are doing?
In terms of government spending on commercial operations?
Yeah, and also, I guess, I mean, they'll be backing projects as well, I assume. I'm just, you tell me.
Yes. The consequence of these changing economics of space means that much of the innovation is being driven by commercial companies, and particularly startup companies. So you've seen various parts of the space market transition from being government dominated to commercial. So if you think about the launch market, that's transitioned to being commercial led with SpaceX. The same is largely true with imaging the Earth from space, and there are many other segments, including potentially the likes of GPS, which is an area that we've been invested in, that we think are following that path. So yes, it's partly a question of being more efficient with money, but I think it's also about pushing the boundaries of what's possible and innovating and doing so at a much quicker cadence than you're otherwise going to be able to do within a government-backed environment.
Yeah, and I guess also because of slightly tangentially, the again, but I think people see some of the technologies you're involved in as being quite crucial to sort of information security and just gathering. Let's say for security, national security purposes, data on what's going on the surface of the planet, right?
It's many different facets of security and the crisis. We can talk just as much about food security and the looming crisis that the world is facing as a consequence of space technology. Has the ability to help us all do more with less. And improve productivity of agriculture, an area that again we're very active in. So yes, it's about providing governments with intelligence to be able to see what's going on the ground. It's also about holding governments to account. We've all seen and the role that commercial satellite imagery has had. A body has been in a precise location for weeks, and it didn't just get up and walk away after someone drove past in taking a video of it. Likewise, more than allegedly 150,000 users of SpaceX's broadband from space service. having an ability to remain online and communicate is absolutely critical. So yes, we really see space technology and the sort of businesses that we're backing in quite a multi-dimensional way, having a very important role to play in reacting to the situation.
Yeah, I mean, so maybe we'll touch on some of the other features of the environment we're in now. So we've got this rising inflation. Maybe it's peaking out a bit. We'll see. And then also on the other hand, we've got tightening monetary policy. I mean, how does inflation directly impact you guys much? I mean, in terms of project costs and so forth, or how much is that taken into account in the deals and so forth?
So yes, it certainly is having an impact. I've alluded to supply chain. Any business, it doesn't matter what sector, that relies upon microelectronics. It's true for large car manufacturers as it is for space businesses. There is a global shortage of such componentry, which that's been a function of a whole range of different market forces over the last couple of years. So it's taking longer to procure parts and it costs more. So that in its own way is obviously a form of inflation, and naturally it's a key consideration for the employee base of all of the companies that we're investing in. So yes, it is certainly manifesting itself, but I think really the critical way of combating that is to be well capitalized, and fortunately most of our businesses are very well capitalized and are therefore able to forward order hard to get hold of expensive componentry to ensure that they're able to continue to execute against their plans, whereas others that are perhaps less well capitalized will unfortunately, I think, bear the brunt of the current market conditions much more significantly.
And in terms of then on the other side, the interest rates, I mean, interest rates have moved up a little bit. I mean, where does that affect, your sort of discount rates you might use to value some of your businesses?
Not totally directly would be my answer. So number one, our businesses aren't leveraged. Very few of them have significant amounts of debt. So it doesn't immediately translate into particularly changing a sort of financial environment for the companies. Two, the stage at which Seraphim is investing is in businesses that are typically revenue generating, but potentially early revenues and pre-profit, and therefore may not yet be at a stage where the application of such valuation techniques necessarily hold water. Clearly, the area that it has the potential to impact is on the availability of capital, and clearly there has been a global sell-off in all things technology and growth related over the course of the last 1 to 2 quarters. And that naturally has some knock-on consequence for availability of private capital, which is at least in part correlated to interest rate and inflation environment.
Yeah, well, hopefully, well, we can go back actually. I guess maybe you can say a bit about the companies that you actually choose in the first place, because I think you've got a certain kind of process before you actually get involved, and how that might manage some of that risk of being able to get capital in the future.
Yeah, so the way that we go about selecting companies is by virtue of being a specialist investor and a pioneering specialist investor. We get to see a vast majority of the global deal flow from seed all the way to IPO stage. So that enables us to build relatively advanced pattern recognition in terms of identifying where there are particular opportunities, leveraging information asymmetry garnered by speaking to dozens of businesses all going after the same opportunities, and then really being able to zero in on the ones that have the right combination of people and product. And then from a deployment strategy perspective, we have been very focused over the last 9 months in predominantly deploying into very well capitalized businesses. So we've typically been investing in rounds of $100 to $200 million that are providing businesses with multiple years worth of cash runway. So as disappointing as current macro and geopolitical environment looks, most of our businesses are in a pretty robust position to be able to not just ride out that uncertainty, but as per some of my previous comments, actually capitalize on increasing demand and actually competitively progress at a faster rate than other companies trying to address the same opportunities.
Great, thanks, James. So, and Steve, you already mentioned a little bit about the contracts at Cordiant. They have escalators. Are those linked directly to inflation, or is it sort of a longer term kind of inflation number you're thinking about? How does that work?
Yeah, probably. I mean, we have quite a number of customers, whether it be government, corporations, probably about 700 customers across our asset base, and they have different escalation clauses. But I would say probably 80% of our contracts have a high degree of inflation linkage. Might be capped out at some level, 3 or 4%. But the other feature of our particular business is that with being real estate assets, is we have very low operating costs, SG&A costs. So maybe our gross margins are sort of 70–80%, and it's really only the operating costs. It's the wage inflation, or it's the consumables that might attract some inflation. But in reality, we get an inflation escalator on our whole revenue stream, of which the large part of it is to cover the depreciation of a fixed asset, and of course that depreciation of a fixed asset doesn't really escalate as a result of an inflationary environment. Of the three assets that we've acquired in the last 15 months on a trailing pro forma basis, we'd be generating over £95 million a year, having invested less than £800 million in those assets. So very, very profitable, growing business with those inflationary protections that I've talked about.
Yeah, thanks. That's useful. And then on the other side, I guess you also calculate NAVs and all the rest. So again, how much headroom is there over sort of current relatively small moves, I guess, in rates, but in absolute terms, where would rates have to go to have a more material impact on NAV calculations, do you think?
Yeah, well, I think they have to stay high for quite a while. I mean, we're relatively conservatively geared on our asset base. Our data center in New York has no gearing, a bit like James was talking about his businesses. Our two multi-asset platforms in Poland and the Czech Republic are fairly conservatively geared, but under some fairly long-term agreements, and certainly in the Czech Republic, very competitive, in view of the current rates, very competitive interest rates agreements. So, so interest rates would have to stay high for quite a period of time, to a time when we'd be looking to, refinance some of those agreements. Most governments are taking action to bring down inflation. Most governments are hoping that they'll be able to, bring down interest rates within the next sort of 18 months, 2 years. But it may well last longer than that. So yes, it could have interest rates over the medium term could have an impact upon a net asset value calculation of an asset. But remember, this is an asset that continues to grow. It starts off with really strong cash flows that continues to grow, and both organically and through the escalation clauses that we contracted with our customers. So I don't foresee a very significant problem unless we end up with 14% interest rates for the next 5 years, and I hope if we do, I guess we will probably be less impacted than a lot of other people in reality.
Yeah, I think that we'll have a lot more to worry about in that, in that instance. Thanks, Steve. Yeah, Josh, I mean, so yeah, if you go into the music stream, I guess there isn't really a sort of direct inflation hedge, but I suppose there'll be some pricing power in some of the platforms. And then actually, there's, I guess what you do is you take a current stream and then you actually do something with that to sort of generate growth. So maybe you could talk about how you add value to those catalogs once you buy them.
Yeah, in terms of the inflation protection, we again earn income from so many different areas, and each one has a different level of inflation protection, if you will. So certain licenses that we have, such as the mechanical royalty rates with streamers, this copyright royalty board that I mentioned, they actually, whenever they review rates, they have to take inflation measures into account. And then a lot of our royalties come from percentages of revenue of different companies. So as long as those companies are sort of protecting from inflation in terms of price increases and things like that, and their revenues are going up, that's going to protect us as well. Yeah, and then just real quickly on the discount rate, that's something that we're looking at closely, and sort of same thing. If interest rates move a lot higher from here, our external valuation firm would have to likely increase their discount rate, but for now they're using an 8.5% discount rate, and then sort of taken into account higher inflation with that already. So so that's where we are on those two subjects. What was
maybe something? Yeah, maybe just on sort of how you're generating sort of additional revenues
right.
out of the
yeah.
assets you buy.
Yeah, we have 70 people at Roundhill, and so we're doing our own property management of these copyrights. We're not outsourcing it to a third party. We do have, for example, 20 people who are devoted just to finding licensing opportunities for our songs. So they are plugged in with the film and TV world in LA and the advertising world in New York, for example, and are constantly trying to pitch our music to be used in different adverts, different TV shows, things like that. That's a big driver. We call that synchronization. And we always want to be very proactive in that area. Another thing that we do is we take our publishing copyrights, so compositions that we own. Let's say What a Wonderful World by Louis Armstrong. Everyone knows that song. Can we have one of our younger female artists cover that song? And can we create a new recording that updates and freshens up a song like that was, originally recorded in the mid 1960s? So we create new assets for ourselves, cover versions of compositions we own, so that, maybe a female vocal version of What a Wonderful World opens up a different opportunity for that song. So those are just a couple of examples of how we might add value.
Yeah, that's interesting and a good insight into it. Mm-hmm. I guess, just mindful of time, but you all listed relatively recently, and a couple of you have another peer that's listed, but it's still a relatively small market. I guess since we're on with Josh now, what do you think makes Roundhill different about the way you do things? Would be just great to hear.
I mean, there are two things that I think of. One is we've been in business since 2010. So we're really the pioneer in terms of private equity focus group dedicated to music royalties. So the experience and the track record, the infrastructure that we've created to property manage these rights long, pretty long tested at this point. And the second thing is a lot of our competition does this, has a structure where they outsource a lot of that property management. So as soon as you hand over the keys to licensing and collection of royalties and all these things, you sort of lose the ability to add value, and you lose the ability to really monitor and track, very closely what you're earning, and your assets get lost in the shuffle at a much larger institution. So we're very proud of the fact that we do our own property management and are just that much more intimately involved with our copyrights.
Great, thanks, Josh. Steve, what makes you different?
Well, we are the first investment trust to focus on digital infrastructure. Prior to that, it was really alternative energy. Prior to that, it was people in the back office, buying Japanese listed stocks who, spoke Japanese. So we are the first digital infrastructure investment trust, which actually gives private wealth managers, institutional investors, individuals the access to be able to invest in a spread of digital assets, whether it be physical towers, fiber, or data centers. And we've been massively oversubscribed. We've deployed the capital very quickly, and we've got shareholders that are encouraging us to give us more money to deploy more capital across these areas. Great,
very succinct. And James, I don't think you really have much of a peer, but what's different about the way Seraphim does things?
So we like to think that we've got a pretty unique model, in addition to, as I've described, really having been the global pioneer in having specialist funds, both private and now public, focused on the space sector. So what are some of those elements of the model? So I think a few things to call out there. I think one is the deep relationships we have with some of the sector's leading corporates who are investors in our funds, so the likes of Airbus and SES and others. So it's through those relationships, which really start at the C-suite, that we are able to avail of the hundreds of thousands of technical and commercial specialists from the sector to help support us in looking at particular opportunities and deciding where to make investments, but also crucially to help support the businesses that we invest in after we've invested. I think another important element is that amongst my team, I have some of the most successful entrepreneurs from the sector who have built multiple billion-dollar businesses within this category. We have our own accelerators. We're not just a fund, so we have a unique model that really acts as a feeder from the very earliest stages of company at the point of inception to then really being able to, particularly through the investment trust, then look to supercharge more growth stage opportunities as they hopefully approach an IPO. And I've talked about before the fact that we get to benefit from seeing just such a large proportion of the global deal flow. So those are all elements that we think are important factors in the success that we've had historically, and that we hope to continue having with the trust going forwards.
Great, thanks. Just if people do want to submit any more questions, please use the chat function. Let's give a couple more minutes for that. And just give a couple of minutes in case anything else comes through. And I think, I guess, looking at the three companies here, there's quite a nice spread of return targets. So we have probably at the top end, James, you guys are targeting about 20% over the long term. From a much more sort of venture approach. And then you've got both Cordiant and Josh's funds, Roundhill Music Royalty Fund, looking at around the sort of 9, 10, 11% range. And I think you're both at the top end of your ranges so far since inception. So that's good to see. I'll just see if we get any more questions through. I can't see much more. So look, with that, we'll close it. We've done about 50 minutes now. I'd like to thank all our speakers. It's been very insightful. We've got, I think, 3 funds that are supported by quite long-term trends in technology, and both successfully raised money. And I think quite clear there's plenty of opportunity to continue to grow in the future with their strategies. So thank you very much, everyone.
Thanks, Rob. Thanks, everybody. Bye-bye.
Bye.